So the debt service coverage ratio, it's basically the ratio of how much money you're making compared to how much money you're spending. So lenders require 1.25. Ours starts off at 1.8, which is crazy high. Most people don't even end at that high. We have something called an interest rate reserve. The lender has given us a little bit extra money to pay themselves back. So that means we don't have this burden on our shoulders of having to pay the debt. So that's why it's 1.83 in the first year, 1.96 that last 2 years, and then it's still 1.6. So even though we got rid of the interest rate reserve and it slowly builds up over there, what that means is we're making so much extra money compared to how much expenses we have. So that's the NOI. So what we could potentially do is refinance. A lot of people call it lazy equity. That means the value of the property is just worth so much more. And the value is directly tied with net operating income, how much money the property is making. At the end, we could do a cash out refi, meaning we send a big chunk of the money back to our investors, also called the infinite return model. So if you get close to getting all your money back, but you still have a stake, like say you have a 1% stake in the property, you're still getting that profit. Ideally, we'll try to sell the property, but Peter, Myth, and I were very patient. We'll do whatever makes sense for our investors. And if we have to hold the property for longer and get a refinance, we can do it. But because we're getting this debt fixed long term, we can really ride out whatever happens. And because the net operating income, the money is higher, even if say interest rates are 7%, we can still cover that. We're really thinking like, hey, what is the worst case scenario and how do we prevent that from happening? I still want a positive return, even if stock market's down 25%. Bonds are down 25%, right? It's protected from that. And that's why, we like real estate.